In this video, I'm going to explain the concept of income investing. I'll explain what type of investors should consider this strategy, as well as pros and cons. And at the end, I have several investments that you may want to consider investing in yourself if you feel like this best fits your personal strategy. So let's go. Also, please consider leaving a like below. It helps so much. And consider subscribing if you want more of this type of content. So I recently uploaded a video called Why Everyone Should Invest in Index Funds, and I received this specific comment. In short, the commenter says that index investing is good for young people, but not necessarily a good option for those close to retirement. And they're not exactly wrong. There's certainly people that have specific risk tolerances and timeframes where index investing might not be their best option. In fact, there's really no one-size-fits-all approach to investing. Most people have different goals, financial situations, and risk tolerances, and it's important for you as an investor to do your research and figure out what type of investment is best suited to your needs. In this case, the commenter noted that he was an income investor. Income investing is a strategy where you invest in assets that provide you a steady stream of income over time. This is opposed to potentially purchasing a stock and holding it for years and eventually selling it for a profit. The ultimate goal is to create a regular stream of income. These investors may want to generate income for daily expenses, for certain specific goals that they've picked out, or potentially to provide income in retirement. It's a strategy that focuses more on stability and regular income rather than trying to find the big home run with a high-risk investment. The companies on the left side of this chart are mature companies. They're not so much growth-oriented as much as they're focused on maintaining their dominance within their sector. Instead of profit being used to reinvest and grow the business, they distribute their profits out to the owners, or those who own the stock. Companies on the right, however, are growth companies, and typically they reinvest their profits back into the business to continue their growth, to continue researching, and to make the company even bigger. People who are investing on the left-hand side are looking for those monthly, quarterly, annual distributions to provide constant income to their portfolio, whereas investors on the right-hand side are looking for these companies to grow substantially, and that's the value, and what drives the price up is the expectation that those companies are going to continue to soar upwards. However, over time, even the companies on the right-hand side will dominate their respective industry, and generally fall over to the left-hand side. The companies on the left tend to be more financially stable and allow you to invest without the stress of constantly worrying about whether the market is up or down every day. That's why they're optimal for people who have already accumulated sizable wealth. I really want to stress the next point. The largest downside to income investing is the fact that growth-oriented stocks will almost always outperform income investing over time. Let me show you an example using one of the best dividend stocks in the market for the last 20 years. This is ExxonMobil. On this chart, I've got the range from 1996 to 2024. As you can see, the stock has gone up significantly over that time. It has fluctuated slightly. However, if you were receiving monthly, quarterly, annual dividends from this stock and reinvesting it, you would have essentially bought the dip every single time and done very well as a essentially 30-year owner of this stock. But let's compare that with Amazon. Amazon here is the yellow line. Now, the issue you might be noticing is that you cannot even see the Exxon line. It's this tiny little line down below. Now, if I zoom in a little, you can kind of see it start to poke its head up. However, this is the vast difference. An investment in a company like Amazon would significantly outperform an investment in Exxon. But at the same time, Exxon investors got exactly what they asked for, a fairly stable, slightly growing stock that's also providing them monthly, quarterly, annual dividends, whatever their dividend is. Whereas people in Amazon weren't sure that was going to be the case. Like, that company could have gone belly up. They could have lost everything. In that sense, it was a high risk, high reward stock. Let's talk about what type of investor would be best suited to be an income investor. Income investors tend to be those with a low risk tolerance. And this could be for any number of reasons. It could just be the fact that it's someone who's not interested in riding the roller coaster all the time. They like the idea that they're going to get money in their pocket every month, every quarter, and that they don't have to think any more about it. There's also those that are close to retirement. Once again, by this point, they're not looking for crazy huge returns, they're looking to use their money to cover their daily living expenses. No one near their retirement date needs to be investing in something that could crash tomorrow. It's important by that point that you just sustain the wealth that you've accumulated. Income investors are also those who desire predictable, consistent returns. They can be those who want additional income sources, or just to hedge against market declines. So now let's talk about assets that you can purchase to become an income investor. The three that I primarily want to talk about are dividend stocks, bonds, and real estate. As I said earlier, dividend stocks are stocks that make payments to their shareholders. These are typically mature companies. They pay you a percentage of your stock ownership, in most cases between 1 and 5%, although there are others that can get a little bit higher. These payments are made on a monthly, quarterly, or annual basis. You also have the option to reinvest these dividends back into the company if you don't want to pocket them. Furthermore, you do have the potential for stock value growth for these specific stocks. So not only would you be getting monthly, quarterly dividends, you would also be gaining from the appreciation of the stock. The second option is bonds. These are loans to the government or to companies with set interest rates. If you were buying a bond, you're essentially purchasing a portion of that loan. The income that you would be receiving is what the government or the company is paying back for that loan. You would receive back both your principal and your interest, and all your payments would come on a monthly basis. Bonds are considered extremely conservative and predictable. The third is real estate investment. Now, this can mean actual real estate investing. You can go buy homes, and while it's going to take a lot of work sometimes to manage them and oversee them, you're going to be receiving rents on a regular basis. This is a type of income investing. If you're not the type who would be interested in that, you can invest in real estate investment trusts. This is ownership in companies that own real estate. They pay you a percentage of your real estate investment trust ownership with payments made monthly, quarterly, annually. These investments tend to benefit you in two ways. You benefit from the appreciation of the real estate value itself and from increased rents. Additionally, there are REITs across all sorts of sectors. You can purchase REITs that specialize in Medicare, or you can purchase REITs that specialize in hotels. Whatever you feel like is generally happening in the economy, you can specifically assign your money to real estate in that sector. Now, at the same time, some REITs cover a broad series of sectors, and if you're more comfortable doing that, that's also an option. Now, those aren't the only fixed income options you have. There are also others, and I'll list them right here. Treasury bills are generally short term, less than 1 year. There's treasury notes, which are more midterm, 2 to 10 years, and treasury bonds, which are long term, 20 to 30 years. In all three of these cases, your money is absolutely locked up during that period. So while it's earning interest, your money is untouchable. Now, there are ETFs that you can buy that closely track these, which is an option. There's certificate of deposits, which would mean you go into a bank and purchase a CD. These have various links, short to long. There's also high yield savings accounts. These provide you monthly interest. And one that's not talked about very often that's actually been great over the last couple of years as interest rates have gone up are money market accounts. These also provide you monthly interest and easy access to your money. Now, what are the largest benefits to income investing? For those who won't be withdrawing from their account, you'll get the benefit of compounding. You'll be receiving income on a regular basis, which will then further increase the size of your investment, which will then give you a higher income every period, which will further increase your investment, and you begin to see how things can kind of snowball. Income investing is generally lower risk than growth stocks. While stocks will always be somewhat volatile, the majority of people who invest in dividend stocks value the dividend they receive and aren't as focused on company growth. While Exxon has fluctuated through the years, they've also provided an extremely consistent annual dividend. Income investments provide you a steady stream of income. What you're seeing here is actually from my personal portfolio. This is the income investment that I've had this year, as well as the projected income for the rest of the year. As you see, in total, I'm going to make $6,000 this year simply on interest and dividends. And while you could argue that the money that I've invested in funds that are providing me this income would be better suited in a larger growth stock, I appreciate the fact that there's a set amount of money every year that I'm going to receive. And the important part is that I'm not just putting all of my investment portfolio into one strategy. Income investing is an incredibly important tool to use alongside growth strategies. A popular key to retirement planning is the rule of 100. What you would do is take the number 100, subtract your personal age, and that would result in the percentage of investments that you should have in growth stocks. The remaining percentage would be what you should have in income investments. So let's say that you're 25 years old. You would take 100, subtract 25, and the result would be that 75% of your investment portfolio should be in growth stocks at that point, while only 25% could be in income investments. On the flip side, let's say that you're 65. Let's take 100, subtract 65, and the result is that you should have 35% of your investments in growth, with 65% in income investments. Now, for some of you, you would consider those to be extremely aggressive, and for others, you would consider that being way too conservative with your money. It's not a set in stone rule. It's just a guideline for people who aren't sure where to put their money at all. And in fact, for many of you who may have 401ks or Roth IRAs that are invested in target date funds, this is essentially what they're doing. And over time, they shift where your money is in those portfolios from growth stocks into fixed income. I don't think I can stress enough how important it is to use your income investment strategy alongside a growth strategy. And I just wanted in this video talking about some very important cons to income investing. Overall, it's simply less risk, less reward. It's predictable, everybody knows what's going to happen, but overall, nothing crazy is going to happen. You're not going to wake up one day and find that Exxon has quadrupled in value. And you're going to miss out on opportunities to invest in companies that are going to quadruple in value. There's also inflation risk. If you had invested in a 10-year bond a few years ago at 1 to 2%, you would now be missing out on the fact that you could just put your money in a savings account and earn 5%. There's also dividend cuts. Sometimes companies don't make as much as they wish that they had, and so they will cut back their dividends. So if you were receiving 4% a year, maybe they come out and say, well, this year we're only going to pay 2%. So while you're still receiving income, it's not exactly what you had planned for. And most recently, you had Intel, one of the oldest income generating companies. They flat out canceled their dividend. Done. There's also taxes. You will get taxed on every dividend that you receive. And it's important that you do research to figure out what types of taxes you'll pay based on where you live. Now, here at the end, I want to provide you with several dividend and income producing ETFs. The first that I want to talk to you about is SCHD. This is a Schwab managed ETF. It's basically just US companies that provide dividends. Currently, it has a 3.43 annual yield. And full disclosure, this is something that I personally have in my account. So what I showed you earlier, a lot of that income is derived from this. I think it's great. It's one of the more popular ETFs right now, very consistent, and I highly, highly recommend it. Another ticker is HDV. This is iShares that specifically focuses in companies with high dividends, has a 3.33 yield. There's VYM, which is a Vanguard owned fund. This is also US companies like the Schwab account earlier, has a 2.71% annual yield. I'm also a very large fan of this next one. This is JEPI, or JEPI as I like to call it, a high yield investment ETF. They basically make all this money via option calls, which you don't have to know a lot about, but what you can focus on is the fact that they have a 7.19% annual yield, which is extremely high and something that you may really want to consider putting in your account. There's also FUSD, a fidelity account that tracks US companies at a lower 1.19%. And something a little different, SGov. This is iShares, where you can essentially invest in treasury bonds without being in a treasury bond. A great option if you don't want your money to be completely locked up and to be able to have liquidity. And this has a 5.19% annual yield. And the last that I want to talk about is another one that I personally use. This is a money market account, specifically with Schwab, under the ticker of SWVXX, a 5.14% annual yield. At the bare minimum, if you have money sitting in a checking account that you're not necessarily using, I would have it in a high yield savings account or a money market account. It's an easy 4 or 5% interest, at least now as of July 2024. It's not July, it's August. At least as of August 2024. So that's a pretty good overview of what income investing is and how you could potentially use it in your own portfolio. For any of my younger viewers, this is probably not something you're going to think about for a while. I really would recommend younger investors continue to invest their money primarily in index funds. But as you get closer to retirement, it's important that you sustain the wealth that you've acquired. And that's where income investing does its best work. Thanks for watching the video. Please consider leaving a like, it helps so much. And also, if you really enjoyed this content, consider subscribing and I'll continue to bring you informational videos like this all the time. So yeah, if you enjoyed this content, please subscribe and I'll see you guys later.